Hello friends, how are you? Again, this is Ronald Chagulanyi. I'll be taking through inflation. Yeah, like I promised to be sending videos, after which we can have a discussion concerning what I'll have sent in the video. Yeah, today I'm going to talk about inflation. Yeah, there are 70 slides, so meaning I will have to present this in something like 3 videos to avoid having very long videos. Okay, yeah, so we're going to look at inflation. Yeah, we're going to talk about inflation, that persistent increase in the general price levels of goods and services in a given period of time. Okay, we're talking about prices persistently increasing in a given period of time. You're going to see what is inflation, what causes inflation, what are the types of inflation, what are the costs of inflation, what can be done to solve inflation. Yeah, that's some of the things we're going to look at. All right, and then we'll try to relate inflation to unemployment. I earlier sent in a video on unemployment, so you will see how is inflation related to unemployment. Yeah, and we'll explain that using the Phillips curve. Okay. So this is some of the outline. Inflation, talk about inflation, demand, pull inflation, cost push inflation, effects of inflation, solutions to inflation, and the Phillips curve. But of course, what I will present here is not everything about inflation. I will request you to go and read more about inflation. I'm just giving you an introduction to inflation. All right. So you shouldn't stop on this. Go on and read more and more about inflation. There are many other things probably will not touch on in this lecture. But what we'll do is we'll introduce us to those different concepts of inflation. Inflation is the persistent increase in the general price levels of goods and services um, in an economy. Okay, so here I put trying to summarize to break down the definition. Inflation is a process in which the price levels rise and money loses value. So when the price increases, automatically money will lose value. Yeah? So it's a monetary phenomenon that involves money. Yeah, it involves money. Okay, there are some key terms we need to know when we talk about inflation. One is deflation, the opposite of inflation. So when you talk about deflation, you're talking about the general level of price, the situation whereby the general price levels are falling or are declining. All right. So the lack of inflation may be an indication that the economy is weakening. You know, for a normal economy, there should be some increase in the prices. Yes, in a situation where there is no inflation, it's an indicator that probably the economy is not performing well. And then the hyperinflation, yeah, the unusual rapid inflation in a very short span of time. Yeah, that unusually rapid inflation, the one which is too high. All right. For instance, there was a case in Germany in 1920s. Yeah, after the First World War, where the prices rose by 2,500% in 1 month. You can imagine. Just in 1 month, the prices rose by that magnitude. It means something you were buying at 1,000. Yeah, within just the span of a month, you would buy it at 2.5. You know, that was too much. Okay. Yeah, then there is another term we talk about is stagflation. It's a combination of high unemployment and high inflation. Yeah. So we said in our previous video on unemployment. Unemployment is a situation whereby people are willing and able to work, but they can't find jobs. Yeah. So in this, with the stagflation, many people are willing and able to work, but they can't find job. But at the same time, the prices are high. Can you imagine? Yeah, that's stagflation. People can't find jobs, but the prices are high. Then what is causing the prices to be high? You know, the idea would be if people are not having jobs, then they don't have money, they don't have disposable income, and so the prices will be low. But in that situation, the stagflation, where the level of unemployment is high and then inflation is high. Okay, so this is the graph or a table which illustrates a figure which illustrates stagflation. Demand pull inflation. Now let's talk about different types of inflation. Yeah, the demand pull inflation. There's that type of inflation which is caused by the increase in aggregate demand. Okay, people are demanding more than what is being supplied altogether, and as a result, the prices tend to go up. Yeah. Okay, so we are saying in demand pull inflation, aggregate demand increases, the real GDP increases above the potential, and the price level rises. I'm going to talk about real and potential GDP. I'll talk about it in the graph which will follow. Okay, all right. Yeah, and so the other thing we need to note is a one-time increase in aggregate demand raises the price level, but does not always start a demand pull inflation. Yeah, so for demand pull inflation to occur, aggregate demand must persistently increase. Recall, inflation has an element of persistence, something which it doesn't happen once in a while or once in a time. It has to be persistent for it to cause inflation. If aggregate demand increases once, that's not big enough to cause inflation. So this is the graph which illustrates the demand pull inflation. You're seeing our initial demand is 80 naught. Yeah, and we're having our short run aggregate supply SAS naught. Okay, SAS naught. Yeah, true. Okay, so initially our real GDP is 600. Yeah, 600. Real GDP is that GDP which has been for which inflation has been catered for. Okay, and then our price level is 130. Okay, so the figure shows that so when there is an increase in aggregate demand from 80 to 81, we are seeing our real GDP increases, and then also prices increase. Okay. Yes, I was still telling you about real GDP exceeding the potential GDP. I was telling you that the potential GDP is the highest an economy can sustain. Okay. Yeah. So when real GDP exceeds the potential GDP, yeah, then there comes an inflationary gap. Yeah, the money wage rate begins to rise and the short aggregate supply curve shifts, say, leftwards. Okay. Those with now let's go to the cost push inflation. Okay, we've seen the demand pull inflation is caused by increase in aggregate demand, but then there's that kind of inflation which is due to the increase in the cost of production. Recall, for production to take place, there are some factors which have to be in place, which are the factors of production, where these factors include land, labor, entrepreneurship. Those are the general ones we know. Yeah, together. So for production to take place, uh, several things I used raw materials and so on and so forth. Okay, so okay, cost push inflation is caused by mainly two things: an increase in wage rate and an increase in the money price of raw materials. Like I told you, labor is one of the key factors of production. Here we're talking about workers; they need to be paid. Yeah, particular. So when the amount of money you pay workers increase, yeah, chances are that the price of the product you're producing will increase. Yeah, for a person who wants to break even, at least altogether. For okay, and then increase in the money price of raw materials. You need raw materials to produce. Okay, yeah, for whatever you produce, you need raw materials. I don't think there's anything you can produce without raw materials. Everything you need raw materials. So if the price of raw materials increased, it means it's now expensive to produce. It will become expensive to produce. And when it's expensive to produce, then the product will become expensive, and hence. So this is just a brief. In a cost push inflation, short run aggregate supply decreases. Real GDP decreases, below potential GDP, and the price level rises. Okay. For the demand pool, it was the demand which was increasing the aggregate demand. But in this case, under cost push, the aggregate supply will decrease. Yeah. You can't supply if you can't produce. or you can supply even more than what you produce. Okay. So if there is any effect on the production, yeah, you can't produce because raw materials are expensive, everything is expensive, then it means you're going to supply less. And you know what happens? If you supply less, then the little you've supplied will be expensive. Are we together? The little you supply will be expensive. Alright. So, and if you want to keep the status quo, it would mean you're going to keep the workers, you're going to continue buying the raw materials expensively, and so to cater for that increase in cost, you have to increase on the prices. How together? So if I want to sustain the market, what I'll do is I will continue hiring the expensive labor. I will continue buying the expensive raw materials. But then to cater for that, the prices of the products have to go up, and thus leading to cost push inflation, and thus leading to cost push. Okay, and still just like with the demand, a one-time decrease in aggregate supply does not always start a cost push inflation. It has to be a persistent happening. um, These are the tables which the graphs which illustrate the cost push inflation. Like you can see, initially we are at AD naught, S naught. Okay, so we are having a movement inwards for the real GDP. Yeah, the short-run aggregate supply curve is moving to the left. Yeah, and the prices are increasing as real GDP is reducing. Short-run aggregate supply decreases and the short-run aggregate curve shifts leftwards. Real GDP decreases and the price, real GDP decreases and the price level rises in a stagger for graphs. Okay. Then here we talk about the hyperinflation. That inflation I talked about, um, which involves very high rates, over 50% per month. Yeah, these are over 50% per month. Yeah, you talked about an example in Germany whereby it was 2,500 per month. Okay. Yeah, so these are some countries which are facing um, or which have ever faced high inflations. These are just part. They're just some of those. Yeah, so that table shows the country and the rate. Of course, you can get read about Zimbabwe. It's one of the countries we've known to suffer from inflation over a long period of time. Okay, so during hyperinflation, money no longer works very well in facilitating the exchange, since prices change very fast and without a predictable pattern. Okay, so people will be confused about the true value of commodities. Different stores will be raising prices at different rates. The same commodities will be sold radically in different prices. Yeah. Everyone spends all their time hunting for bargains and finding the lowest prices. People spend time looking out for the lowest price. Yeah, you move from Kauga to Buguju to Mukono town looking for a cheaper bread. And the bad thing is, you can leave Kauga when they are selling bread at 10,000. You will go to Buguju, you find it at 15. You decide to go back to Kauga to buy the one for 10. You come back when it's at 20. You sell them, you can buy the one for 15. In Buguju, you find it's at 30. Yeah. So it happens very fast, meaning that you can spend a full day looking for cheap bread. But the more you move, the more the prices keep on increasing. Yeah. So, cause of that, several problems are likely to occur in the economy. So, in most cases, the government has to act very fast to deal with the hyperinflation. To deal with the hyperinflation, there is a serious inflation. Something can move a bread which they were selling at or a soda which was at 1,000 can go to from 1,000 to 50,000. Imagine altogether. Meaning sugar which was at 30,000 will go to 150. I mean, which was at 3,000 will go to 150,000. And recall there are some goods which we can't live without. Yeah, altogether. A Guinness which was at 5,000 goes to 50 or 250,000 altogether. Yeah, some people will strike. They can't live without the products. They can't live without the products. So the government will always have to come in as much or as soon as possible to deal with the problem. Okay. So one of the causes of hyperinflation is excessive money growth. When there's a lot of money in the economy, and this is mainly caused by at times government actions of printing more money, yeah, and spending unwisely. You know, the government at times spends, it's the big spender, you know, but at times they spend unwisely. Yeah, they give out money to those who praise them. Like if at all you are against Chagulanyi, they give you a sack of money. Yeah, so if they continuously give people money, you find people with the rooms full of money altogether. So chances are that that money will be penetrated into the economy, and the prices will have to shoot. Altogether, imagine if all of us have a room full of money, or if 10 of us have a room full of money. You know, altogether. Yeah, and there are times when the government prints money. If they want to avoid borrowing and so on, they print money. So if you print money which is not followed by production, or which is not backed up by gold, there will be a lot of money in the economy. And if everyone, you know, a good economy is whereby Chagulanyi has 1 million when Patra has nothing. That's okay. Yeah, yeah. All of us are not meant to be with money. A good economy, some people should be with money, and others should be looking for the money altogether. Yeah. So if I have 1 million, Patra has 1 million, Naroga has 1 million altogether. So that's a lot of money. Yeah, Andrew has 1 million, you know. But if I have 1 million, Naroga has 50,000, Patra has 2,000, and Andrew has 20,000. That's normal. But if each and every person is having a lot of money, yeah, one demand will increase. Yeah, when demand increases, those people will always increase prices. Altogether, if there's only one shop in Kauga selling sugar, and if they have one sack, and the entire Kauga is coming with money to buy sugar, what do you do as a seller? You have to increase the prices, be it at 100%, you know. Okay. And then we have so here you can see that if a government wants to spend specified amount of money but it's collecting less taxes, it must cover the difference in some way. The government may borrow from the public and issue bonds. We'll talk more about bonds and treasury bills. Yeah, the government borrows from public, not everyone, of course. They borrow from those with money. They don't borrow from every Tom, Dick, and Harry. But there are some people with money. Yeah, there are some people who can borrow the government. So as you're praying, pray that one day you can borrow the government. That's my prayer. That one day they can knock me and they're like, you know what, Chaplain, give us 1 billion. And I'm able to give them the billion. Yeah. So there are some people like how I will be in the future, from whom the government borrows money and issue bonds which are payable in the future with interest altogether. So the government may also opt to print for new money. To print new money. Yeah, and of course, there are some people, unless if you have a clear or a clear-minded economist running, let's say the Bank of Uganda, yeah, you can have situations whereby if the president wants money, they just call. I think it has ever happened in Uganda. They just call and they print more money. That's not right. Yeah, you don't just print money. It has to be backed by gold. Okay? Alright. So you can read about what the monetarists are saying, Feldman, Noble. Yeah, so let's now go into the effects of inflation. Yeah, so regardless of whether its origin is demand pull or cost push, inflation imposes some costs. And these costs depend on whether it's predictable or unpredictable, or anticipated or unanticipated. Yeah, here let's talk about anticipated inflation, the fully anticipated inflation. When the inflation is fully anticipated, people will be able to know what is going to happen. Yeah, you can know if and that inflation at 4%. Yeah, workers will be able to know that the nominal wage increase of 4% may not real mean real wage increases. And so people will always be prepared. Yeah, here we talk about the menu costs. Yeah, menu costs. Of course, one of the effects we already say the menu cost increase and so the standard of living decrease. Yeah, the actual physical cost of changing prices, the what we call the menu costs, altogether. When you go to the market and you find a difference of 50,000 or 5,000. Yeah. So those actual physical costs of changing prices are what we call the menu costs. It can be in form of foregoing what we were initially eating, postponing, doing several other things altogether. If you were eating a kilogram at home, you end up eating a half and a quarter, etc. Yeah, anticipating inflation also avoids the distribution of income, errors in investment and saving decisions. So these are some of the costs of anticipated inflation. Yeah, that's the inflation they can predict. You can know that if this happens, the price will go up to this level. No, well, we don't which can predict and anticipate. Yeah, it has the bottle leather costs, other transaction costs, decrease in potential GDP, decrease in the long-term growth rate. These are some of the costs of the anticipated inflation. Okay. And then the unanticipated inflation can cause the following problems: redistributive income between firms and workers. It moves real GDP from the potential GDP. Yeah. It redistributes wealth between borrowers and lenders. Yeah, then I'll ask you to find out who loses between the borrower and lender. Okay? Assuming there is an increase in inflation, who will lose between the borrower and the lender? Think about it. When we meet for a discussion, I want you to tell me who loses. Is it the borrower or the lender? Yeah, assuming there is an increase in the prices, or assuming there is inflation, who will lose between the borrower and lender? Of course, it also results in too much or too little saving and investment. Yeah, too much or too little saving and investment. Yeah, too much or too little saving. All right. So I was talking about too much or too little investment. Yeah, inflation can cause too much investment. Yeah, the higher prices can attract people into investing. You know, investors, if you see the prices are very high, you'll be like, wow, let me also invest. And that has some repercussions. Okay. Or too little investment. Okay, saving an investment. Yeah, some people may be hesitant to invest. It becomes too little, and the problems which you can follow, unemployment, and so many other. Yeah, because unanticipated inflation causes the people try to anticipate it. Interesting. Yeah. To make the best possible forecast of inflation, people use all the information they can about the source of inflation and likely trends in those sources. Yeah, and such a forecast is what we call a rational expectation. Yeah, and unanticipated inflation avoids some of the costs of inflation. If you can anticipate it, then we can prepare best for it. Yeah, so these are some of the costs of inflation, anticipated inflation and anticipated. Probably in financial, you can read those ones. Then our next lecture is going to be on Philip's curve. Please go and read more about more other costs of inflation. Yeah, and go and read more about some causes I didn't talk about. Those are things which causes inflation. Yeah, you know them. Those others are together. A lot of money coming to the country, importing from inflationary prone countries, and many others. Yeah, poor infrastructures. Yeah, so you can read more about what causes demand pull inflation and what causes cost push inflation, and any other type of inflation I might have not talked about. Okay, so our next lecture is going to be on the Phillips curve. Yes, so the Phillips curve is going to follow in our next recording. All right, thank you very much for now. Please watch that video, note down what you think you need to understand, and read more. Please read more and read more. I'm just introducing you to the topic. There are several other things I didn't talk about, other causes I didn't talk about, other types of metal I didn't talk about, other effects I didn't talk about. Please go and read more. Yeah, I'm going to come back and talk about the Phillips curve. Thank you very much.